Hi, folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory in Birmingham. Today is Tuesday, January 26th, and we thought we would come to you with a brief update on the market, just let you know how things are going out there. The S&P 500 is right around 3860 as I speak, which is very, very close to all-time highs, if not at them. And we are in the middle of earnings season. So 4 times a year, companies report earnings, and at those times, sort of all eyes turn to the companies that are out there to give us a little bit of a view on what's going on in the economy. Currently, we've had about 70 companies in the S&P report, 70 of the 500 that make up the composite. And those numbers have come in a little bit better than expected. We've been at about flat on earnings growth with revenue growth of about plus 1% a year, year over year. This is for the fourth quarter. That's versus expectations of about a 10% earnings decline and about a 1% sales contraction. And if you think about it, the fact that we're actually seeing revenue and earnings growth, or at least flat to slightly up revenues in the fourth quarter, despite the fact that we are still in the midst of all of the pandemic-related lockdowns, is a really, really positive sign, at least for the larger cap companies that are reporting in the S&P 500. Once again, we get this little dichotomy between those larger businesses that make up Wall Street and the smaller businesses that make up Main Street. Certainly Main Street's hurting, but Wall Street appears to be, taking this in stride and actually growing a little bit despite the pandemic-related business shutdowns. So that's all positive news. I think it explains a little bit of the positive tailwind to the market here over the past couple of days. It's pretty quiet out there away from earnings. We certainly have a little bit of surrounding when exactly and what the stimulus package that comes out of the current administration will look like. They've argued it has a headline number of about $1.9 trillion. The actual economic impact of that is likely far smaller, likely about half of that. The folks at JP Morgan were right at about $980 billion in terms of actual spend that will happen. A lot of that gets transferred to other folks, not the federal government. But still, there's concern as to when exactly that might come out and exactly how large that might be. We have a very accommodative federal bank, basically keeping rates low for a very long time as a positive backdrop for the market. And we have basically, some idea that eventually, whether it's early spring, mid-spring, late spring, early summer, eventually the virus-related restrictions on the economy get lifted and we start to get some real economic growth associated with people, getting back out there, traveling, getting back to work and doing all those other types of things. Those are all the sort of positive backdrops for the market. On the negative side, we certainly have valuation. Valuation as a negative is frequent when we see rallies like this. We also see interest rates, which could push higher. That's one of the things that I think is a known out there. However, short-term rallies in interest rates are usually pain points that last for a couple months, and then people realize that when you get economic growth in the back of the short-term rallies in interest rates, those are generally positive for equity risk classes. So it's a relatively benign environment. It's relatively quiet out there, and all eyes, I think, will continue to be focused on earnings over the next couple of weeks. As always, if you have any questions, please feel free to reach out to myself or to your advisor. Hope you have a great week, and I look forward to talking to you again soon.